This is Mish Schneider, Chief Strategist of MarketGauge.com. And I'd like to thank Stockcharts TV for giving me this opportunity to be with you all today. My goal is to walk you through the macro, particularly as we're looking at the price charts on some of the indices, a lot of the outliers, and then work our way down. What makes this particular time in the market so fascinating is that we could be seeing an actual sea change in terms of what the Fed has been promising they would do and what they might do. And that would be, of course, possibly lowering interest rates. Is that good news or bad news? So we may be getting to a point of having a fabulous opportunity in certain sectors, while others may have already been long in the tooth. And of course, there's always commodities, which, as you may know, is one of my areas of expertise. So let's get started with my favorite grandpa, Granddad Russell 2000, as we look at the daily chart. Now, as you're looking at this chart here, what you can see is that we have a break today of the 50-day moving average, and that is the first time we've seen the break of the 50-day moving average since we had this gap lower way back in April, way back. It's the beginning of June, but things seem like they're taking forever. What's so interesting about it this time was that the momentum, which had really crashed, had the mean reversion, which turned out to be the bottom of the market. We're looking now at our Real Motion ACP plugin. And as it was rallying, notice how the momentum never cleared the Bollinger Band while we did so in times past back here. So that kind of gave us a clue that while the SPY and the Nasdaq were making new all-time highs, the Russells were telling us a completely different story. And now look at how the momentum here has really broken down and now is not necessarily in divergence as we're taking out the 50-day moving average, but actually we are seeing momentum a bit worse than the price. So that means we have to look at this low here, which is at 201.78, the last time we were under the 50, and A, ascertain whether or not we're going to break that, and B, if we're going to have 2 days of a close under the 50-day moving average, that would put us back officially into a caution phase. What's also interesting, if we look at the leadership benchmark here, which is how this instrument is performing against the SPY, you can also see that we have been underperforming the SPY, and now we're breaking down on the Bollinger Band there as well. So essentially what I see from this chart is that we could wind up holding the support levels right now and have a bounce. It's possible. But if we cannot do that, then we'll be looking at a gap fill to these highs right here, which would be right at around under 200. And then if that fails, of course, we'll take a look at what happens as we get closer to 195. This certainly is telling us right now that a lot of the economic statistics we have seen, including what we saw most recently, which is the JOLTS report, was at something that has only been seen 3 times in history, where there are fewer job openings. That always has led to some kind of contraction, not only in the market, but in the economy. And now they're saying that they may have overstated the jobs report by 770,000 jobs. That's a huge mistake. So these are all the things the Fed are watching, and certainly we should be watching as well. Now, if we move to what really capped us off in terms of this possibly happening, it's actually something that Dave and I talked about on the last time I was on Final Bar, and that is the transportation sector. So as we're looking at transportation here, when everything else was doing really well for that period at the end of April and then into May, this really did not participate in the rally. Now, if I were to zoom out and you take a look at this going back to 2022, you'll see that we never took out the 2022 highs, let alone making new highs in 2024, while we did in so many other instruments, particularly obviously in Nasdaq and growth stocks. So this was already flashing to us. There was something wrong with a huge part of the economy. And let's face it, transportation is 6% of the GDP, number one, and a huge jobs creator, number two. So where are we at right now? Well, after a massive move lower, it almost looked like we were going to recapture this 200-day moving average. And instead, we did it only for 1 day, which was the end of the month, last month on Friday. But we started out better on Monday and sold off, and now we're kind of getting a follow through here as I'm talking to you on Tuesday, June 4th. But notice the inside day here. So that kind of supports what I just said about the Russell 2000, is that it doesn't look great, but it doesn't necessarily look all that horrible yet, because with an inside day, it's very possible that we could see this bounce right back over, let's say 64 tomorrow, and continue on up. I would say different ball game completely if we can get through 65 and then obviously the 50-day moving average. But if not, we break down under these lows, I think that pretty much tells you that the summer rally many were anticipating may not be happening. Now, we also here, looking at the momentum indicators, we had a mean reversion to the upside right when we had this little bit of rally here. But it didn't last very long, and it never was able to clear the moving averages. And now we're actually below the zero line. We're certainly not at the momentum levels we were when we made this low a few weeks ago, or I should say a couple of weeks ago. But nonetheless, momentum is not going in the right direction. And you can see that this has been well underperforming the SPY. I mean, really, look how far back we have to go to March to see just how poorly transportation has been doing. So to me, as a member of the modern family, this has been a great sign of caution. That doesn't mean there aren't areas of the market that are doing well, but certainly we would need to see this pick up in order for us to feel comfortable. And the other one, which by the way was an incredibly reliable indicator last year for the crash that we saw in March, would be the regional banks. And I know people don't really think about this sector very much because it's not sexy like growth in NVIDIA. But nonetheless, this is a huge part of the US economy, particularly as we look at a lot of the commercial real estate. And there is some reports now that there are still many, many banks that could possibly default, something you don't see very much in the headlines, but this is really telling us that things aren't so great. So as we're looking at the regional banks here, you have to keep your eye. We've been kind of in a range for quite some time now, really basically between 45 and 51, 52. It never has stayed up there too long or broken down under 45. But nonetheless, if we break down under this 200, along with everything else I just mentioned to you about transportation and the Russells, take that as you should, with good warning that things aren't so great. And even, and we're going to talk about this in a moment, if the Fed does wind up having to lower the rates, is that such good news? Now, we still, in momentum, we can see a bearish divergence here as we're looking at this underneath the 200-day moving average and momentum, while it's above it on the price. So the momentum could be foreshadowing more weakness to come along with everything else, or it could be telling us right now that the momentum is actually worse than the price action. Where would I get better, friendlier, I should say, to this? Again, like I showed you with IYT, this would have to be a little bit higher up. It would really have to get back over 50. And you can see that this is well underperforming in terms of the leadership against the SPY. So now I think it's really important to talk about the TLTs, because this has been really lagging, and in fact, peaked in December of 2021 as the Fed got way more aggressive with the interest rates throughout 2022 to fight inflation. And now, even though we have PCE numbers that showed somewhat of a softening of inflation, as we know, there are many factors involved with inflation that kind of put it into a square peg, round hole type situation. You have aspects of inflation that have really cooled off, particularly oil. And yet the precious metals are still relatively high, even though they've corrected. And also on top of that, we still have some other concerns, particularly if we're talking about AI and the usage of raw materials that AI has, putting a strain on certain metals like copper, aluminum, tin, silver. And that's a part of the reason why we could be looking at inflation bursting out differently than what we've seen it in the past. So what happens here? Why am I even mentioning that? Well, first of all, let's start with the real motion indicator. Look at how this not only broke out, we had a one mean reversion here just as it was hitting the 200-day moving average, and then it sold off. But we also never really saw the momentum decrease the way we saw the price once it broke the 50. And now not only are we back through that Bollinger Band, but we're back through the zero line, something we haven't been now since the beginning of April. But what makes this time a little bit different is that we're also through the 200-day. Now, we've been there before, and we need a couple of closes, no doubt. But this is the kind of situation where, and I'm going to show you this real quickly, if we take a look at the weekly chart here, I think the weekly chart is incredibly interesting because if you look at the weekly chart, notice this 50-week moving average. We have not had 2 weeks in a row of a close above the 50. Even here, it closed above and then right on it, above and then below it. And here we are now approaching. So keep this in mind as we get through this week, particularly with a jobs report at the end of the week after this JOLTS report today. And you can pretty much see that if this closes above, let's say, 93.25 on a weekly basis, not only is that a good signal, obviously we want to see a second week, but if we take a look at the whole chart pattern, you see that we've had a series of higher lows. Now, just going back quickly to the daily chart here, the other thing I want to point out that's extremely important in terms of our risk factors is that the long bonds are actually outperforming the SPY. And when that happens, that is the ultimate risk-off environment, number one. And number two, right now, forget stagflation, we could be going express lane to recession, and that's why it would be so dangerous to see these bonds go up much higher than they are right now. Now, the other very interesting relationship that I love to watch, and I'm going to talk about this just very briefly, are the junk bonds. And if you take a look at the junk bonds right now, they are not doing as badly. So here maybe would be your sort of hope trade that the support levels we showed you in IYT and IWM and even in KRE hold. And maybe this is some kind of a false breakout even in TLTs. And we start to see that summer rally. That's why I cannot be definite with you at this point, but open-mindedness is the name of this game. And to me, the most exciting thing, because if you're in your positions, you know what your stops are. And if you're looking to add and catch some kind of a summer rally, we'll know really soon whether or not that's going to happen. And this is actually not such a bad chart to be looking at because you've got that 50-day moving average. We're still in a bullish phase. The momentum, of course, is still somewhat in a bearish divergence because it's under the 50. And it's neck and neck with the SPY right now. So if this starts to outperform the SPY, that's not necessarily a bad thing because you want high yield, high debt bond traders to feel good about getting involved with that type of instrument. Okay, so now let's move on because I mentioned a lot of areas that have potential weakness, which will bring the market down, but also possible hope. Here are a couple of sectors in the modern family that look good. And right now, I'm very interested in the biotech space for a couple of reasons. Not only are we in a bullish phase, but I really like the fact that it's having a sort of a narrow range inside day with the IWM, the Russell's being down today, sitting on its 10-day moving average. Momentum has improved. We really want to see the momentum get through these levels here. And then I think, especially if we start taking out these highs and get closer to 140, we could see biotech rally. Now, what's interesting about biotech is that it's both a cyclical and a non-cyclical, and that it can do well in a recessionary time and can also do well during an expansion. So it would be a matter, obviously, of picking and choosing wisely as far as which instruments you might want to get into. We're looking at two in particular, one being Pfizer. I'm not going to show you that chart right now, but it's been trading between 28 and 30. And if it gets through 30, that could be a really good opportunity. The other interesting thing about this in terms of the momentum that I showed you having to get through the Bollinger Band is look now neck and neck with the SPY. So that would be a place to go if this continues on up. The other place to go, it's not granny retail because granny retail is very nuanced right now, but this is actually consumer staples, and that's having quite the breakout today. Now, of course, that makes sense because in a recessionary time, people are going to buy what they need. In an inflationary time, they're going to buy what they need. So this is kind of getting us prepared economically for either scenario, maybe stagflation or maybe recession. And so obviously, if the whole market gets dragged down, we know there can be an overall liquidity crunch. But if this maintains itself, then right now, I would say you're looking at around 77 to hold, maybe a little bit lower than that. Here's your 50 at around 75.90. But take a look at your momentum here. Your momentum is through the Bollinger Band, still has more to prove, but notice how it's now starting to outperform the SPY. So what is this telling you? The consumers are still in the game. They're just switching how they're spending money. Okay, so now let's move on a little bit more micro. So first of all, Bitcoin, as I'm talking to you today, is actually perhaps showing itself separating from the rest of the market. And I have to tell you, this is something that I've been waiting for very patiently, was for Bitcoin to show that it is not a risk asset, that it could be a store of value, and that after the halving, it's really done nothing except consolidate. And if it's now going to hold over the 70,000, can it go to 80 or higher? Maybe. But there's a stock that I've been in, and I've been very vocal about it with the company. And this is going to benefit for many reasons. Also, the ETF for the Ethereum helps it too. But it hasn't done very much. And now it's starting to look really interesting to me. This would be Coinbase, of course. So now if you look at Coinbase, you have the 50 crossing, the 10 crossing the 50. It's starting to get some movement above the 50. If we go down to the momentum, we're still in a negative momentum, so it's got a lot of room for this momentum to catch up. But notice how well it's outperforming the SPY, or the benchmark also needs to get through the Bollinger Band. So it's possible that we'll see this start to outperform even greater, that we'll see the momentum go up even greater. But right now, just in terms of price resistance, we get through 250 right here. This would not be a stock that I would be afraid to buy on momentum. We certainly saw that momentum play back in February when this thing rocked and rolled its way all the way up to its high, which was at 283. I think from 250, we can see 280 easily. And if we just scroll back a little bit here in time, we can also see how well this is consolidated here at around 195, 196. That's a really big area to hold. But that also tells me that we could see maybe a $60 move up from about 250, which would put it at a target around 310. Now, I wanted to talk to you about silver a little bit because, yes, it's a commodity. It's a commodity I still very much like. It's in correction. And if you looked at the cash chart, which we're not going to look at right now, we would say that $28.70 in terms of the cash price for silver is probably a good support. But we're going to look at SLV because most of you are going to trade it through the ETF. So if we take a look, I'm going to scroll out here. What we can see right now is clearly we had the mean reversion. We had a double top here at around that $30 in SLV. And now people are starting to get very negative here. I actually think that if you look at the underlying chart, I'm still thinking that this has a lot of room to the upside. And I think if we can get to a move to around 2650, which would be around 2870 in the cash price, then it's possible that you would have an opportunity. If you waited for it to 50, you might miss the boat, but you might have an opportunity to get in there. I'm still very long-term bullish the silver. This has done a lot of work. This does not feel like a top to me. This just feels more like exhaustion. And here's your 50-day moving average here on the momentum indicator. And yes, it's slightly now underperforming the SPY. So I would also want to see not only this move to around the 2650, where you can see my cursor right now, which would be right here at under this high that I'm looking at right here from May 15th. But also we would want to see this momentum start to come up and outperform the SPY. So now what I want to do, and by the way, keep your eyes on sugar. Sugar, if it can get through 20 cents a pound, I'm going to show you cane here, because again, that's how most of you would buy. But if sugar gets through 20 cents a pound, then I would see a cane at around 1170. this might be another opportunity. Look how this is starting to outperform the SPY. Look at the mean reversion here. So that's sugar, by the way, and silver often tend to move together, which is kind of a bizarre relationship, but it's something I've looked at over time. All right, now let me give you a couple of stocks to look at before we go. Things that are setting up, obviously defense and cyber security is still a very big area to be looking at. I've been sitting in Palo Alto for a while, but this is now starting to look more interesting to me. Palantir, you kind of had that big gap here, and then it failed terribly on that gap down, probably sucked in a lot of longs and then got a lot of people hurt. We've not played this. Might be the second time I've ever been interested in actually buying this particular stock. But what I like about it is the mean reversion, the outperformance here again on the leadership of the SPY. And, these plugins have just really helped me so many times, prevented me from getting in on false breakouts. Look at the momentum here. It cleared the 50, but it still showed such weak momentum at this point. It wasn't convincing to me. Just like here, we're having the mean reversion showing better momentum, but I'd really like to see this clear over the 50. And the leadership is telling me that this is going to be the first time this is outperforming the SPY before we had that big rally. So now all we need to do is wait and see 2 closes over the 50-day moving average for a phase change. And that would be a phase change to bullish. So I think that would be extremely positive. And the other one I want to show you is so completely different than anything I've ever shown before. And that is Nu Skin. And the reason why I like this is I have been all over the vanity trade, starting with the particular drug companies that are making the drugs for obesity. Obviously, Eli Lilly, which has went up to new highs, Novo Nordisk, which has been doing really well. There's a couple of ETFs to be aware of, OZEM and HRTS, that takes advantage of that. And we've seen companies like ELF do well. My theory is that at some point, as this gets more mainstream, we will actually also see people who are losing weight and keeping it off doing things like Botox, possible some plastic surgery, and taking better care of their skin. And I like this stock. It came up in my search for things that would benefit. And not only that, if you look here, you can see it's a consumer staple, right? We just looked at the consumer staples. XLP is a great area. So I'm going to end with this thought. And that is that if this thing now, and if we kind of bring this back a little bit here, we'll see that there was a gap right up here after it reported poor earnings, the gap to 1734. Currently, we're trading at 1355, and we're above the 50, so we're in a recuperation phase, and we're above the 10. Look at this momentum. I mean, it's just flying, and it's outperforming the SPY. I would probably want to see a close above this 1396, let's call it 14, with a pretty good risk to under the 50. And it's possible that in time, getting into this kind of cheap, you might see this stock return to places that it hasn't been in quite some time. It was trading at one point well over $35. So that's it for now. In summary, like I said, keep an open mind. This could be the start of a much bigger correction or the start of a great summer rally. And really, I think the bonds are the clue here for one. So keep your eyes on those TLTs. And I hope this was informative to you. You all have a great day. Thanks so much for watching. Thanks again to Stockcharts TV, and bye for now.